Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's 7th of November 2023 and here are the questions we'll be answering today. Should the EV subsidies continue? Will this Diwali be as bright for rural India? How will assembly elections in 5 states affect markets? And what is AQI? India's Heavy Industries Ministry wants to extend subsidies for electric vehicles under the FAME-3 scheme for 5 years. It also wants a higher allocation to support the growth of electric and alternative fuel vehicles. But the Finance Ministry is against it. It has reportedly questioned the rationale behind the proposal, saying major electric two-wheeler makers have benefited the most from FAME-1 and 2 schemes, and they don't need further support from the government. So should the EV subsidies continue? Tariq Ahmad has the answer.
Two contrasting views are emerging from two central government ministries on rolling out subsidies for production of electric vehicles in India. The Heavy Industries Ministry recently proposed to extend the subsidies for electric vehicles under proposed FAME-3 scheme with a higher allocation for 5 more years. It wants the government to continue supporting the growth of electric and alternative fuel vehicles in the country. But there is a department which is not keen on it. The Ministry of Finance has reportedly questioned the proposal to continue subsidies for electric vehicles under the Faster Adoption and Manufacturing of Electric Vehicles or FAME scheme beyond the current fiscal year. Under the first stage of the FAME scheme, which kicked off in 2015 and ended in 2019, the government had allocated 895 crore rupees. The FAME-2 scheme began right after that in 2019, with a larger pool of funds at 10,000 crore rupees. It comes to an end in 2024. The first 2 phases of the FAME scheme are said to have played a big role in promoting the growth of electric vehicles. It helped EV achieve a 6% market share. With FAME-3, the government wants to accelerate the pace of this transition. The proposal also includes adding trucks to the list of vehicles. But why is the Finance Ministry against it? According to reports, officials in the ministry are of the view that the major electric two-wheeler manufacturers, who were the largest beneficiaries of FAME-1 and FAME-2 schemes, don't require any more government support. Also, the production-linked incentives are already being provided for manufacturing batteries and components for EVs. And it also comes against the backdrop of several two-wheeler EV makers wrongfully claiming subsidies under the scheme. The government has taken the subsidy amount back from most of them. The Ministry of Heavy Industries is in talks with the Finance Ministry to finalize the segments to be targeted under FAME-3 scheme and about the amount to be allocated. That allocation of funds to each segment will depend on the EV penetration across the country in each segment and the availability of funds. So should India continue the EV subsidies under the FAME scheme?
Should the subsidies continue? I think the answer is yes. FAME, if we look back, right, was created with an intention to create demand, to build a good technology platform for India, and also create a large charging infrastructure. That's where the money was being planned out across various uh, automotive segments. However, if we look, fast forward, there has been a significant growth, but still, overall, 43% of the fund has been utilized till July 2023, which tells us that there is still scope for spending. That's one. Second is that the initial growth was not as fast as it was expected. Hence, there were some changes in the FAME-2, which actually led to some adoption. And it's a good indication that probably, the more you provide incentives to the customers, organically this is growing. Going forward, there are a lot of expectations from the stakeholders on FAME.
So far, the FAME scheme has provided support to more than 1 million vehicles which are running on Indian roads. The FAME 1 scheme supported 2.78 lakh EVs with demand incentives worth 343 crore rupees. The FAME 2 scheme, which commenced from April 2019 for a period of 5 years and allocated 10,000 crore rupees. The FAME 2 scheme was intended to support 7,090 e-buses, 5 lakh e-3-wheelers, 55,000 e-4-wheeler passenger cars and 10 lakh e-2-wheelers through demand incentive. According to the data from July 2023, so far 7.4 lakh electric two-wheelers, 83,420 three-wheelers, 8,982 four-wheelers have been sold under the scheme. And currently, only the electric buses and two-wheelers are closer to the target that the scheme set out to achieve. Out of the more than 19.2 million vehicles registered in the country so far this year, EVs only amounted to 12,45,276, which is just 6.4%. Since most of these EVs are in the two-wheeler and three-wheeler category, the penetration of EVs in the cars and buses is less.
This is exactly what the government of India is parenting the electric vehicle industry in India, and therefore the industry is growing. Now, how much of parental support will be required through schemes like FAME 3, through tax concessions like GST, reduced GST, through concessions like road tax waivers, etc., etc. These are matters of policy which will obviously have to be decided. But the child has not yet grown up to a stage where it can stand completely on its own. So if you ask me in simple terms, I think more support is needed. The shape and form of that support obviously has to change.
Also, experts mentioned that in order for the EVs to get a faster adoption, the battery prices have to come down.
As far as the personal passenger cars are concerned, already there are several brands available in the Indian market. They are being purchased. But you should remember that the price point of those vehicles is significantly higher than petrol vehicles. Today, a median car price in India is around 8 lakhs of rupees, or maybe between 7 and 8 lakhs of rupees, whereas an electric vehicle is approximately 2 times that. So therefore, obviously, there is a price challenge that will have to be overcome as we keep going forward. But this price challenge will narrow down, in my opinion, as the battery prices get more rationalized and local production of all the components and parts becomes more intensive than it is today.
Experts say that the FAME scheme should be continued as the penetration is still not very high. Two-wheeler market has seen a better adoption on the back of the subsidies under FAME schemes. But in the passenger vehicle category, the prices of EVs are still way higher compared to the diesel and petrol variants. So, bringing down the prices of batteries is important for the faster adoption in coming years.
According to McKinsey, electric two-wheelers are expected to account for 60 to 70% of new sales in India by 2030. But rural demand is not growing at a fast clip as expected. While sales of two-wheelers are picked up, signs of distress are still visible in the rural belt. So will the upcoming Diwali lift the spirits of people in villages? Ayush Mishra explores.
The onset of the festive season has boosted consumer confidence. Most high-frequency indicators have demonstrated stronger performance during the first half of the current financial year. Consumer confidence also reached a 4-year high, indicating a positive sentiment and growth momentum in urban areas. But rural India is still grappling with challenges of poor monsoon, lower income and higher inflation. Roma Dikshit of One Lattice expects a modest surge in rural sales during the festival season, but that is not going to sustain because of poor harvest and declining household income.
There can be some marginal increase that we will see in rural India sales, and that could be primarily driven due to Diwali being a very auspicious time to buy goods. But we feel that it is unlikely to sustain in longer run because no other macro factor is suggesting that. There has been poor monsoon which impacted the Kharif harvest, output is lower, income is lower, and we will see that impact in their spending too. Rural households are more cautious on their spending now given the poor harvest and lower incomes.
Latest consumer confidence survey of the RBI indicates households remain optimistic on future earnings even though their current earnings remained same over the months. This was driven by prospects for employment, income and spending in urban areas. The quarterly urban unemployment rate declined from 7.6% in April-June 2022 to 6.6% in April-June 2023. People are also less pessimistic on prevailing price levels and inflation when compared to a year ago. Among the indicators, sales of passenger vehicles, consumption of steel and petroleum products, passengers handled at airports, and railway freight traffic have all shown an upturn in the first half of the current fiscal. However, the indicators capturing rural demand, such as tractor and two-wheeler sales, has yet to demonstrate consistent improvement in the current year. Q3 FMCG growth at 7.2% reflects a slight slowdown from the stronger Q2 FY23 numbers at 8.5%. This is primarily due to urban growth stabilizing at 8% after a rapid 12% surge. Meanwhile, rural growth continues at a steady 6.2%.
According to RBI's consumer confidence survey, we saw that rural consumers are less optimistic about the current economic condition than the urban consumers. This could be primarily due to higher income, inflation, drier monsoon that has impacted the overall spending of rural India. This was reflected in the automobile sales as well, which is primarily tractor and two-wheelers. The tractor sales fell by 10% this September compared to last year, and it has been flat mostly this year. If we see other indicator, which is FMCG consumption, we have also seen marginal growth in rural area. However, according to top FMCG companies, the growth is still not at par what we saw before COVID. So overall, we feel that there will be some jump in the sales, but it won't be sustainable for longer run.
Because of the K-shaped recovery, there is considerable stress in the rural consumption basket. While rural sales are going to be muted this Diwali compared to last year, Amit Goyal of Pace Group believes it is not going to be as bad as it was anticipated a few months ago.
Northeast and the eastern part of the country, that is where the maximum stress is, because they are not gaining from the food inflation because they grow mostly grains, and that is where the prices have not gone up, and that is where, and because their production has suffered because of a bad monsoon, so that part of the country is not going to do well. But I think the central part, the western part of the country, and even to some extent the southern part of the country is going to do better. And another thing which I would want to add here is that next year, everybody is expecting more largesse from the central government ahead of the elections. So my sense is that between now and the next few months, the rural demand is also going to pick up in anticipation of these dole-outs from the central government ahead of the elections.
Urban India is set to experience a bright Diwali, where the rise in inflation has been largely offset by rise in asset prices, a flourishing real estate, uptrend in stock market, and the overall boom in urban economy. But the scenario is distinct in certain rural areas that have been grappling with a poor monsoon and persistent high inflation. Many are hopeful that the upcoming general election will bring some relief post-Diwali.
After Diwali, let us now turn our focus to another festival. The elections, also known as the Festival of Democracy, begin today with voting in Chhattisgarh and Mizoram. Usually, state elections are a non-event for the markets. But are the markets viewing the current elections in the same way? In our next report, Puneet Wadhwa speaks to market experts on what Dalal Street is pricing in and what should be your investment strategy ahead of the polls.
The semi-finals leading up to the 2024 general elections are set to kick off on November 7, with 2 of the 5 states going to polls today. Voting for Mizoram Assembly and first phase of Chhattisgarh will commence today. This will be followed by casting of votes in Madhya Pradesh, Rajasthan and Telangana. Markets usually overlook state elections as their results do not necessarily reflect general election outcome. For instance, the Bharatiya Janata Party won the 3 state elections of Rajasthan, Chhattisgarh and Madhya Pradesh in 2003 but lost the general election in 2004. Similarly, the BJP lost these states to Congress in 2018 but registered a landslide victory in general election of 2019. This time, however, investors are closely following the 5 assembly elections.
Not the objectives are normally different, but here two things. Some major state elections are due in December, so their contribution in the Lok Sabha is quite significant. And second, the time gap between these state election and the Lok Sabha election is quite short. So therefore, the outcome might lead to a lot of calculations, a lot of permutation and combination in the anticipation of the results outcome from May general election. So to that extent, it may have some influence on the markets.
As the 5 states going to polls together contribute around 15% of Lok Sabha and Rajya Sabha seats, analysts at Morgan Stanley caution that either the state election results or move from the opposition alliance that seem to be gaining momentum could raise the market's concerns in the near term. Against this, how should investors reject their portfolios?
The investor should allocate around 50% to large Sensex and Nifty stock and also top 250 stocks. Out of the balance also 5% to gold ETF, at least 5-10% cash within the equity asset class. The balance could be small and mid cap.
For now, analysts believe markets are pricing in the BJP's win in the upcoming state as well as general election of 2024. They could, however, fall 2 to 3% in case the poll outcome throw up a negative surprise on December 3. Today, on 7th of November, Q2 results of India Inc., global cues and voting trends in Mizoram and Chhattisgarh will sway market mood.
He's making plans for an early retirement. Business Standard.
While soaring benchmark indices may lift your spirit ahead of festivals, a look outside the window may dampen it if you are in North India. Financial capital Mumbai's AQI too entered the red zone on Monday. But what is AQI? We explain it.
The Air Quality Index, or AQI, tells us how clean or polluted air of a particular region is. The higher the AQI, the worse the air. In 2014, the central government had launched color-coded AQI under the Swachh Bharat mission. According to the Central Pollution Control Board, the AQI transforms complex air quality data of various pollutants into an index value, nomenclature, and color. The pollutants measured include PM10, PM2.5, nitrogen dioxide, ozone, carbon, etc. There are 6 to 8 pollutants in air, and each of these pollutants is given a weight based on a formula. That weight depends on the impact of each pollutant on human health. So, instead of giving you 6 different numbers, it gives up one single number to denote the overall impact. The levels of these pollutants are assessed by the monitoring stations, which are set up across the country. Based on the AQI levels, the governments in areas like Delhi announce their measures. Currently, Delhi is under stage 4 of GRAP, disallowing non-essential construction work and barring entry of diesel-run vehicles. There are 6 AQI categories, namely good, satisfactory, moderately polluted, poor, very poor, and severe. Each of these categories is decided based on the ambient concentration values of air pollutants and their likely health impacts, known as health breakpoints. According to the AQI scale, the air quality between 0 and 50 is good, 51 and 100 is satisfactory, 101 and 200 is moderate, 201 and 300 is poor, 301 and 400 is very poor, and between 401 and 500 is severe. The Centre's Pollution Control Board has devised a Graded Response Action Plan, known as GRAP, to contain worsening pollution in the national capital. As the name suggests, it is a graded response measure employed depending on the severity of the air quality. It has 4 different sets of response stages.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But in most hill stations, the AQI is hovering close to 50. Well, that's all for today. For more news, views and analysis, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.